What is unfolding right now is not simply another geopolitical crisis that dominates headlines for a short time before fading into the background. This is something far more consequential, far more complex, and far more dangerous in its long-term implications. The war involving Iran is no longer contained within the Middle East or limited to military calculations alone. Its shockwaves are already moving across borders and oceans, and now they are being felt with growing intensity inside China. But China's response to this moment may not just rattle markets. It could fundamentally reshape the global financial system, weaken the dominance of the US dollar, and ignite one of the most dramatic shifts toward gold the modern world has ever seen. What most people still fail to grasp is what is quietly building beneath the surface inside China. Chinese households and private investors are sitting on an enormous reserve of capital, a mountain of money that has been deliberately parked inside the banking system. Nearly $7 trillion are locked away in fixed-term deposits across Chinese banks. This is not spare change or idle savings. This is structured wealth, carefully placed to earn returns and preserve stability. But now, a critical turning point has arrived. This year, a massive portion of those deposits is reaching maturity. That means trillions of dollars are about to be unlocked, freed, and repositioned all at once. And the timing could not be more destabilizing for the global financial order. Why does this matter so much right now? Because the world is standing on the edge of a conflict that threatens to tear through energy markets, supply chains, and financial systems simultaneously. If the war involving Iran escalates, it will not remain a regional event. It will pull in Europe, pressure the United States, and inevitably drag China into its economic consequences. History has shown us repeatedly that when major powers collide, markets do not hold steady. Stocks collapse, oil prices surge, gas prices follow, shipping routes become dangerous or unusable, inflation accelerates, and paper wealth vanishes far faster than most people expect. The warning signs are already impossible to ignore. In just 2 days, nearly $2 trillion have been erased from U.S. stock markets alone. This is not theory or fear-driven speculation. This is real destruction unfolding in real time. Chinese investors are watching this closely. They understand that if the United States becomes fully entangled in a large-scale conflict, its markets will bleed further. When markets fall, stocks lose value. When stocks lose value, trillions disappear. And when inflation rises alongside sanctions, instability, and currency pressure, holding cash inside banks becomes a losing strategy. Inside China, interest rates on fixed deposits are hovering around 1%. In a calm world, that might be acceptable. In today's environment, it is meaningless. Inflation, volatility, and geopolitical risk are rising faster than those returns can compensate for. Chinese households are not blind to this reality. Business owners are not naive. They know that earning minimal interest while global instability accelerates is not wealth preservation. It is slow erosion. That realization leads to one unavoidable question. If money leaves the banks, where does it go? For years, real estate was the default answer. Property absorbed massive amounts of Chinese wealth and became the cornerstone of household investment strategies. But that era has changed. The property market has cooled sharply. Growth has slowed. Confidence has weakened. The momentum that once fueled endless expansion is gone. Stocks, once the next logical destination, now look increasingly fragile. Global equity markets are already under pressure, and with the risk of war hanging over everything, one major escalation could send them into free fall overnight. That leaves one asset standing where almost everything else feels unstable. Gold. Gold today is no longer viewed simply as a commodity or a speculative trade. It has returned to its oldest role, a store of value in times of chaos. For Chinese investors, gold represents something tangible, something real. It cannot be printed at will. It cannot be digitally erased. It cannot be frozen by sanctions with the press of a button. Physical gold exists outside political systems and currency regimes, and that reality is becoming more attractive by the day. This belief is spreading rapidly, not just among wealthy elites or institutions, but among ordinary households across China. This is where the situation becomes truly explosive. Imagine what happens if even a portion of that $7 trillion begins moving into gold. If just $5 trillion shifts toward gold purchases over time, the global market simply cannot absorb that demand without prices spiraling far beyond anything seen before. Gold would be forced into entirely new territory, levels that would shock investors and policymakers alike. People would look at price charts in disbelief, wondering how such a dramatic surge happened so quickly, unaware that the decisions were made quietly and deliberately long before panic ever became visible. And this shift would not occur in isolation. China is not acting alone. India has already been increasing its gold accumulation. Central banks around the world are stacking reserves at the fastest pace in decades. Even in the United States, investors are slowly beginning to move away from dollar-based assets and toward tangible stores of value. If war breaks out, oil prices will surge first. Gas prices will follow. Shipping lanes through critical choke points will slow or shut down. Inflation will roar back with renewed force, and history tells us that when nations go to war, their currencies inevitably weaken. The US dollar now faces one of the greatest challenges in its modern history. If global confidence erodes and trillions of dollars flow into gold, demand for the dollar declines. When demand declines, dominance fades. This is not speculation. This is how financial power has shifted throughout history. Wars do not create these changes from nothing. They accelerate transitions that were already forming beneath the surface. If the conflict escalates further, the reaction will be swift. Energy markets will move violently. Investors will abandon risk. Capital will rush toward perceived safety. And gold will once again become the anchor people cling to when trust in financial systems begins to crack. Chinese investors understand this instinctively. They are no longer chasing high returns. They are prioritizing survival of value. They are preparing for a world where volatility is permanent, where sanctions and freezes are normalized, and where digital controls make traditional assets increasingly vulnerable. In that world, gold is not viewed as an investment vehicle. It is protection. It is insurance against instability. What is happening now inside China is not panic buying or emotional decision-making. It is calculation. It is a slow, methodical repositioning of wealth ahead of a storm that many believe is inevitable. By the time headlines begin screaming about record-breaking gold prices and collapsing confidence in fiat currencies, the most important moves will already be complete. The capital will already be deployed. The momentum will already be unstoppable. The world will react only after the shift has fully taken hold. That is why this moment matters so deeply. The decisions being made quietly today inside Chinese households, businesses, and investment circles may soon reshape the global financial landscape itself. And when the world eventually looks back on this period, it may not describe it as just another chapter of geopolitical tension or a familiar cycle of conflict and recovery. It may be remembered as the moment when trust in paper promises finally cracked, when confidence in systems built on debt and assumptions gave way to something far older and more tangible. Because once conflicts of this scale ignite, they do not end neatly or quickly. They do not wrap up in 10 days or fade after a few weeks of headlines. When leaders become targets and red lines are crossed openly, wars are not managed toward compromise. They are pushed toward their outer limits. That is why what lies ahead carries risks far greater than what the world witnessed in Ukraine. In that war, core leadership structures were preserved, boundaries remained partially intact, and escalation was carefully calibrated. Here, the calculus is entirely different. If targeting leadership becomes strategy rather than threat, the scale of retaliation expands dramatically and the consequences multiply beyond control. This type of conflict never remains confined to its origin point. It spreads outward, first across the Middle East, then far beyond it. And when the Middle East ignites, no economy escapes the heat. Investors understand this instinctively. For decades, the Gulf region, from Saudi Arabia through Qatar, has been treated as a relative safe zone for capital, a place where stability encouraged money to flow, projects to grow, and assets to be protected. But the moment war stretches across the region, that perception shatters. The first response is hesitation. Deals slow. Commitments pause. Capital stops moving forward and begins looking for exits. And then the most important question emerges, quietly but urgently. If money is no longer safe here, where can it go? During wartime, investors do not speculate. They seek shelter. Real estate is quickly ruled out because property freezes when uncertainty rises. Buyers vanish. Liquidity disappears. Stocks are next. But when markets are already shaking, equities offer little more than amplified losses. Oil may surge temporarily, but it is volatile, politically exposed, and inaccessible for most people. And so, once again, the flow of capital narrows toward a single destination: gold. This moment is not only about China, though China remains central to everything unfolding. It reflects a broader human instinct that activates when optimism collapses and fear takes its place. The conflict surrounding Iran will not stop neatly at one border or one outcome. China understands that it cannot afford to watch Iran fall without consequence, because once that happens, the pressure does not dissipate. It shifts. If Iran is weakened or dismantled, Iraq becomes exposed. Syria follows. Lebanon is dragged deeper. Palestine remains trapped in perpetual fire. Then attention turns outward, toward Qatar, toward Turkey, toward North Africa. Even Saudi Arabia cannot assume immunity. Everyone involved understands that once a chain reaction begins, it does not stop where planners initially expect. Beyond the Middle East, the implications ripple further still. If Iran is struck decisively, China and Russia cannot ignore the precedent. Leadership structures everywhere take note. The world has already seen leaders detained, governments destabilized, regimes pressured through indirect means. No major power views those events as isolated. Silence, in this context, is not weakness. It is calculation. Behind closed doors, technology transfers, intelligence coordination, and strategic planning are already shaping what comes next. Iran's ability to challenge advanced systems, to down high-value assets, and to maintain missile capabilities did not emerge by accident. It reflects years of external input, particularly from Russia and China. That reality alone ensures this conflict cannot remain local or short-lived. Now consider the economic consequences layered on top of this instability. If key trade routes are threatened, if shipping lanes slow or fracture, export-driven economies feel the damage immediately. China, more than any other nation, depends on the uninterrupted movement of goods. Trillions of dollars worth of products leave Chinese factories continuously. When shipping slows, factories stall. When factories stall, costs remain, but revenue collapses. Tariffs have already demonstrated how fragile this system can be. Even limited disruptions have reduced operating days, cut production cycles, and squeezed margins across Asia. A full-scale regional war would magnify those pressures beyond anything seen before. This is why Chinese investors are not waiting for confirmation or official announcements. They are acting ahead of the crisis curve. They have already watched how gold prices respond to fear. They remember how quickly demand surged the last time uncertainty rose sharply. Now, with the possibility of war spreading across entire regions, the logic becomes impossible to ignore. If the world is moving toward sustained instability, why hold assets that require stability to survive? This mindset does not stop at China's borders. When Chinese buying accelerates, it sets off a wider response. India watches closely. Southeast Asia adjusts. Western investors, already uneasy, begin repositioning. This is how momentum forms. Slowly at first, quietly, almost invisibly. Then suddenly, all at once. Trillions of dollars do not move overnight, but once direction is established, reversal becomes nearly impossible. What emerges from this is not panic, but alignment. A synchronized shift driven by the same conclusion reached independently across different societies and financial systems. That risks are rising faster than protections. That currencies tied to conflict lose credibility. That markets inflated by leverage and debt cannot withstand prolonged shocks. And that when uncertainty becomes permanent rather than temporary, tangible value becomes priceless. This is why the current moment feels so heavy, even before the worst has arrived. Not because destruction has peaked, but because so many actors now sense what is coming. The signals are everywhere. Diplomatic warnings stacking up, markets swinging violently, energy anxiety spreading, military posturing becoming more overt. None of these developments exist in isolation. Together, they form a pattern that investors, governments, and ordinary people can no longer dismiss. And so the movement toward gold continues, not as a trend or a headline-driven reaction, but as a defensive posture. A way to step outside systems that feel increasingly brittle. If even a fraction of global capital follows this path, the consequences will be historic. Prices will surge, supply will tighten, confidence in fiat currencies will weaken further, and once that feedback loop accelerates, it reinforces itself. This is why understanding this moment matters, not to provoke fear, but to recognize reality as it is taking shape. Because by the time the consequences are visible to everyone, the choices that shaped them will already be far in the past. As this story continues to unfold, awareness becomes essential. Staying engaged, questioning narratives, and understanding the deeper forces beneath the headlines matters more than ever. This is why conversations like this exist, and why voices like NextGen-Fox continue to analyze, connect, and challenge assumptions. Stay aware, reflect on what you are witnessing, and share your perspective, because moments like these are rare. They do not simply pass. They define eras, reshape systems, and leave marks that last for generations.